In case number 33 is all about calculation of earnings per share. Let me directly guide you the calculation of EPS one after one, and finally I'll just go for guiding you the theoretical aspects also, right? Now, earnings per share is nothing but earnings available to equity shareholders divided by equity share, number of equity share capital in numbers. Okay, in numbers. Though the formula seems to be pretty simple, you need to know some additional points here. For example, you may have 10 rupee shares fully paid. 10 rupee share paid up to 5 rupees. Then how can you calculate the equity number of shares, the number of equity shares? You can convert that to weighted equity number of equity shares. Weighted number of equity shares. So in the denominator, rather than simply equity shares, number of equity shares, we can calculate weighted number of equity shares. If I have 100 shares fully paid, another 200 share 50% paid means this will be considered as 100 shares and this will be considered as only 5 out of 10, no? 50% paid up means 200 share will be considered as 100 fully paid up shares, like so 200 will be the weighted average number of equity shares. Weighted average number of equity shares. Is that okay? Even sometimes 10 rupee shares on 1/4/2025, the year beginning, 5 rupees collected, and 1/7/2025, another 5 rupees collected. As on 31st March 2026, what is the number of equity shares you have? To this portion, out of 5 rupees, only 10 rupees collected. Remaining 5 also collected means 10 rupees out of 10 rupees collected. Then you have to calculate what is the average, weighted average equity number, equity shares here based on this proportion. That will be the denominator. That's how we can calculate the EPS. Not only EPS, you need to calculate diluted EPS also. Diluted EPS. Diluted EPS is nothing but earnings available to equity shareholders is replaced with the potential earnings available to the equity shareholders divided by potential weighted average number of equity share capital. What is that potential means? For example, in the year end we have 100 debentures probably convertible into equity shares in the coming days. Now what happens in the next year? Will you be able to get the same EPS or the EPS gets diluted? Diluted means the EPS what you expected will be decreasing. The EPS what you expect may be increasing future is not dilution, that's anti-dilution. You never bother about that. If there is a chances of a reduction of EPS you calculated in the future because of some changes in the number of equity shares as well as earnings available to the equity share, then that should be quoted as diluted earnings, diluted EPS, earnings per share. For example, 100 debenture is converted into equity share capital. Because of this conversion, what happens? In denominator, equity share capital will be increasing to the extent of conversion of debt to equity. And in numerator, no. Because of conversion of the debenture into equity shareholders, you will be now saving the interest. That interest will also be addable in the numerator. So in numerator, interest is added, in denominator, number of shares also added, then earnings per share may be totally different. If the earning per share is compared to the previous earnings per share is decreasing, then it's called diluted. Then diluted means you have to state in your statement the expected dilution possible for your EPS also in your financial report. Is that clear? So basic EPS, earnings available to equity shareholders and weighted number of shares, and diluted EPS, potential earnings available to equity shareholders divided by potential number of shares. And we have been given the additional notes also. Potential equity shares must be ranked in the order of dilutive effect. It is not only conversion of the debentures into equity share capital, sometimes preference share also converted into equity share capital, or some other reasons also, options also may be there, warrants also may be there. Based on these reasons, the number of equity shares in the denominator may be increasing, numerator also getting affected. Okay, so using that you have to find out the dilution. See, for example, 10 rupees is the earnings per share you expected. Because of this conversion, your earning per share decreases to 9. Then it's called dilution. If the change after the debenture converted into equity shares, rather than EPS decreases from 10 to 9, if it is from 10 to 11 increases, so this is called anti-dilution, never bother. So shareholders are pretty happy if their EPS is more than what we expected, they will be happy, no need to intimate this. But in case if the EPS is decreasing, you have to give the warning to the shareholders ahead. That's why when there is a dilution possibility, you have to intimate. So the dilution possibility may be due to the conversion of debentures to equity share and preference shares to the equity shares and redemption of debentures and buyback of equity shares. There may be n number of reasons. Because of n number of reasons, the EPS may be getting diluted. For example, 10 rupees, after one change, it may be 9. Another change, maybe it is 7. Another change, it may be 9 rupees 50 paise. Another change, it may be 11 rupees. Okay, so this is not a reason for the dilution. Among the three, the most diluting nature will be this one, no? So you have to start with this one, and second one being this one, third one being this one. That's how you can rank the diluting effect. Ignore in case of anti-diluting. In case of anti-dilution, it should be ignored. Is that clear? Now, let's see. So, any shares, we'll start with the TCS company shares now. Tata Consultancy Service. In their case, we'll start with the income statement and then balance sheet or ratios. Yeah. Hope you will be now come across with these two EPS, diluted EPS and basic EPS. So while disclosing, the company should disclose its basic EPS as well as diluted EPS. Majority cases there will not be any dilution, it remains same. When the dilution happens, when there is any buyback of shares or redemption of debenture or conversion of debenture into equity shares, these things will have the dilutive nature, then it will be shown separately. Clear? Now let's see. The following information has been provided by A Limited. Determine profit and loss attributable to ordinary equity shareholders. Come on, find out the earnings available to the equity shareholders from this illustration. It's very simple one. Gross profit for the year ended being 3.5 lakhs. Okay, GP. And your other operating expenses being other operating expenses 1 lakh, 2 lakhs 50,000. This is earnings before tax. Tax rate being 30%. 75,000 is subtracted to get the earnings available to tax. Earnings after tax 1,75,000. Out of these two, preference dividend 10%. So for this 20, you have to pay the preference dividend 2,000 rupees. 1,73,000 will be considered as earnings available to the equity shareholders. And number of equity share capital being 1 lakh. So EPS in this case being 1.73. What about the diluted EPS? Diluted EPS, there will not be any change. Unless there is any changes like the thing what we have discussed is there will not be changes in diluted EPS. Let's directly go for some practical questions for your better understanding. Then I will give the summary. Okay, finally I will give the summary. Find out the weighted average equity shares. On 1st April 2020, balance at the beginning of the year being number of equity shares being 3000. How many shares are there? 3000 shares are there. Date and number of shares. On 1st July 2020, first shares issued another 900. On 31st March 21, 800 shares were bought back. Now what about the number of shares you have? You have 3000 from 14 to 17 2020. On the date your share becomes 3900. Thereafter 800 subtracted 3100 shares are there. So you have to find out what is the weighted average number of shares as on this date. How many months we have the shares being 3000 from 14 to 17, 4, 5, 6, 3 months. Number of months we have the shares in our books as 3000 being 3. 1720 to 31st March, 9 months we have 3900. 3100 for 0th month. So you multiply these two, this will be the cumulative shares you have in monthly basis, 9000. And what about this one? 3500 and 4400. This is for year. Per month and an average, come on, tell me, divide this by 12. 3675. This will be the weighted average number of shares you have. Weighted average number of shares you have. Number of equity shares. Is that clear? Shall I move on to the next question? This is nothing but calculation of weighted average number of shares. Come on, make a note of it. So we'll move on to the next one. Shall I go for the next one? SSA Limited had 1800 shares outstanding on 1/1/2020. Paid of rupees 10 on 31/10/2020. 600 equal shares of rupees 10 each, but 5 paid up. 10 out of 10 paid up, 5 out of 10 paid up. Calculate the weighted number of equity shares as on 31st December 2020. Okay. This will be fresh issue. This will be the fresh issue. Initially 1800, then another 300. 600 shares but equated into 50% only, as 50% is paid. Cumulative number of shares being 1800 and 2100. From this date to this date, almost 10 months we have 1800, and for this last 2 months we have 2100. So cumulative number of shares into number of months it exists 18,000, and this will be 4,200. Overall 22,200. But anyhow, you have to divide this by 12. Monthly average. 1850 will be the final answer. Next, basic EPS and bonus shares. Net profit for the year 2021, 25 lakhs, and 21-22, 75 lakhs. Number of equity shares outstanding on 31st December 2021 being 20 lakhs. Shares, 20 lakhs. Bonus issue on 1st January 2022 was 1 equity share for each equity shares outstanding on 31st December 2021. Okay. So then you will have 40 lakhs here with the bonus shares. Calculate the basic earnings per share as well as diluted earnings per share. Now for the year 2021, otherwise 2021. EPS is equal to earnings available to equity shareholders divided by weighted average number of shares. Weighted average number of equity shares. So in 2021 being 25 lakhs divided by number of equity shares being 20 lakhs. 1.25 is the EPS. But you can expect that you are going to suppose to issue the bonus shares in the coming date. As you plan to go for bonus shares, definitely next year your EPS should not be 1.25, it should be reduced to lesser value, reduced to some other value so that the bonus will have the dilution. So you have to calculate the diluted EPS here. And the diluted EPS, earnings available to equity shareholders divided by weighted average number of equity shares. Potential earnings to the equity shareholders, potential weighted average number of equity shares. There is no any change in revenue because of the bonus shares. Because of the issue of the bonus shares, what happens? The number of shares increasing. It is nothing but converting the free resource to the bonus share. Of course, because of no extra capital invested there, revenue will not be having any change. So in numerator, the revenue remains the same, 25 lakhs. But in the denominator, after the bonus shares, the number of shares being 40 lakhs. Now your earnings per share 1.25 decreases to 0.625. 0.625. What about the year 2022, sir? In that year, we have been given this data. You can find out the EPS. EPS in this year being earnings available to the equity shareholders divided by weighted average number of equity shares. So here numerator value being 75 lakhs and denominator value being 40 lakhs. So you get 1.875. Can I calculate the diluted EPS, sir? No, we cannot calculate. Diluted EPS can be calculated only when you are expecting some changes in numerator and denominator in the coming years. In 2021 itself, we are sure that in the next year we are supposed to issue the bonus shares. We predicted that. So after the bonus issue, the number of shares will be increasing in the denominator without having any impact in the numerator. So there is a dilution. But originally in the 2022, bonus share also issued and original earnings also we found out. So then we can calculate normal EPS. We will not calculate the diluted EPS. In most other cases, in your examination for the first year, you will calculate EPS and diluted EPS. In the next year, you will calculate only EPS. Clear? Come on, make note of it. Clear? Text me. We'll move on to the next one. Now, calculate EPS, diluted and basic, and convertible debenture is also there. 1,06% debenture issue was sold on 1st April 2020, convertible into 10,000 shares of equity, 10,000 shares of equity shares. Okay, convertible into 10,000 equity shares. Assuming that net income is 2 lakhs. So earnings available to equity share being equity shareholders being 2 lakhs. Weighted average equity shares being 1 lakh. Weighted average equity shares being 1 lakh. And effective tax rate being 40%. Calculate the EPS and diluted EPS for this year. Okay. This share issued on this date may be convertible in the next year. Now for the year 2020, EPS basic, earnings available to the equity shareholders divided by weighted average number of equity shares. Earnings available to the equity shareholders being 1 lakh divided by number of equity shares being 2 lakhs. 0.5 will be the earnings per share. What about the diluted EPS? Potential earnings to the equity shareholders divided by potential weighted average number of equity share capital. What about the potential earnings available to the equity shareholders? See here, 1 lakh rupees. Currently we have the debenture paying 6% interest for that. Because of this reason, you pay 6,000 rupees in the current year. This 6,000 will reduce your earnings per share, but interest will be subject to tax rate. So minus 2,400. In the next year, interest saved will increase the earnings available to the equity shareholders. Add interest saved. After the conversion of debenture into equity share capital, you don't pay the interest. If you don't pay the interest, 6,000 profit will increase. Earnings before tax increases by 6,000. Tax 40% will go off. So increase in earnings available to equity shareholders being this much 3,600. Now the increased earnings available to the equity shareholders being 2 lakhs 3,600. What about the change in earning equity share capitals are here? The debentures are converted into equity shares. Now after this conversion, the equity share capital will increase by another 10,000. So now the new total number of equity shares being 1,10,000. Potential earnings available to the equity shareholders being 2 lakhs 3,600 divided by potential weighted average number of equity shares here being 1,10,000. Then the ultimate value being Okay, this one is wrong. 2 rupees and 1 rupees. I got surprised. There should be dilution. No. This ultimate value being 1.89. So the value decreases. No, it's called dilution. Sir, why don't you adjust in the numerator in case of bonus share, sir? Because of the bonus share, there is no any change in the earnings. Okay. But because of the debenture converted into equity share capital, you save the interest component, so earnings will also be changing. Equity share number of equity share also be changing. Clear? How can we adjust all these things? The list is given here. See. If you are issuing the shares for cash, weightage will be given from the receipt of cash. Okay, if you are issuing the shares on 1st January, so year being 1/4/2025, ends on 31st March 2026. First issue happens on 1/1/26. Then weightage will be given for this will be from here to here only. Against conversion of debt is converted into equity share, then what happens? The moment when interest ceases to accrue. So what happens, in the current year, 1/4/2025 to this date, interest will be payable, thereafter interest is going to be stopped. It means the debt is converted into equity share on 1/1/26. So you have to give the weightage from this date onwards. Is that clear? That's the logic. While assigning the weightage, this is a simple format. I have given around 16 items where 3 or 4 may be very important to know. Rest you can guess it easily. In case of cash, from the date of receipt. In case of conversion of debt, what happens? The moment the debt is ceases, means thereafter you don't pay any interest. From the date, the weightage will be taken. And in case of mandatorily convertible instruments, okay, like debenture converted into equity share or preference share converted into equity shares, and the contract is entered into. So as per the contract note, when the conversion happens, the details is available. From the date you can start calculating the weightage. And you have not paid the interest for a longer period, or the debt also remains not paid. So this fourth one is not required. It's a replication of this one. So you can score out this. Okay. And 5 also the same. 4 and 5 are similar to conversion of any debt, like, okay, interest, principal, settlement of liability. So all these things are from the date of settlement. But what happens if you are purchasing the asset and instead of paying the cash, you are giving the shares? The date of acquisition recognized in your book will be considered as weightage date, okay? Date of issue of the shares, like. For rather than purchasing the asset, for getting any services, if you are issuing the shares, when you enjoy the benefit of service, automatically from the date the weightage will be assigned to the shares. In case of partly paid up fraction, if it is being 3 rupees paid up out of 10, 3/10 will be the fraction you can apply for the shares. Already we have studied. In case of amalgamation, A company merged with B company, amalgamation. That amalgamation of in 2 types. One is purchase method, another one is merger method. In case of purchase method, from the date of acquisition, weightage will be assigned. From the date of acquisition, weightage will be assigned. In case of merger, full year will be taken. In case of merger, full year will be taken. Anyhow, the purchase and merger concept is not applicable for your study at your inter level. Anyhow, you might have studied in your partnership chapter in your group 1 syllabus. So partnership amalgamation, partnership conversion. Similarly, company can be merged with another company. This is called merger, where we have 2 types. One is merger, another one is purchase. Whenever it is treated as purchase method of amalgamation, and from the date of acquisition, weightage will be assigned. In case the amalgamation is treated as merger, though it is happening halfway through, we have to calculate the weightage for the whole year. Okay, whole year. Anyhow, you will study this merger and purchase model at your final level, not here. And in case of bonus issue, full year. We have already applied the full year concept for the bonus issue. In case of right shares, what happens, sir? We need to use the right factor. I have to teach you in detail this one. So this is required to be studied properly, right? And others you can simply skip very easily. You can guess. Hope you will be able to understand. So predominantly, I have expected the students to get the question from right issue and bonus and share split. Even in case of partly paid up and fully paid up cash, these things may be expected in your examination. Others may not be available for your examination purpose. Now, we will be dealing with the right shares here. We will be dealing with the right shares. What happens in case of right shares, sir? Right shares. Let's see. Neil Limited issued 5 lakhs equity shares of ₹10 each, fully paid amounting to ₹50 lakhs. So weighted average number of equity share currently being 5 lakhs. It issued right shares among the existing shareholders on 31st July 2021. So right shares are issued on which date? 31st July 2021. Okay. In the proportion of 1 new share for 2 outstanding shares. 1:2. So already 5 lakhs means 2.5 lakhs new shares will be issued at the rate of ₹50 per share. Okay. But the market price of the company share prior to the right issue being 90, but market price being 90. So right shares will have two component. One is issue of shares for cash, another component being the bonus shares. 90 rupees share issued for 50 means 50 rupees is issue of shares, like another 40 rupees is considered as bonus share. So it's having two components here. I am going to consider only the bonus component. Okay. Net profit before the tax for the year being for 2021 and 21-22, 11 lakhs and 13.5 lakhs. Corporate tax being 30%. Anyhow, corporate tax is not required for us. So 2021, you have to calculate basic EPS. Basic EPS being earnings available to equity shareholders divided by weighted average number of equity shares. What about the earnings available to the equity shareholders in this year? 11 lakhs. What about the weighted number of equity shares they have currently? 5 lakhs. So 2.2 will be the basic EPS. Probably it is before tax means, yeah, this is before tax. I can now subtract the tax component into 1 minus tax rate. Then 1.54. Simply clear? In case of diluted EPS, you have to find out earnings available to the equity shareholders, especially potential and potential weighted average number of equity shares. There will not be any change because of the bonus component. Only when you are issuing the shares in cash, there will be change in the numerator. If you are investing 100 rupees, you will get a revenue for that 100 rupees invested. In case of right share, there is a cash component as well as bonus component. Cash component, forget about that. But in case of non-cash bonus component, no. Because of the number of shares will be increasing without any change in the numerator. So it is now going to be calculated separately using the right factor here. So 11 lakhs into 1 minus 0.3 divided by, what about this value? This value will be calculated using the right factor in case of right shares. This will be the value here. How do I calculate the right factor here? Let's see. For the calculation of right factor, let me explain here. Okay. Now, you have to find out X right price, okay, market price divided by X right price. This will be called as right factor. Market price being 90. What about the X right price? X right price is nothing but overall number of shares you will have after acquiring the right shares. For example, shares held plus eligible for right shares. If you hold 2 shares, you will get 1 right share. If you want to hold two shares, you need to purchase at 90 rupees in the market, 180. Then you will be given 1 shares to be purchased at what rate? 50. So overall you have to pay 180 plus 50, 230 rupees for how many shares? For 3 shares. Then come on, tell me what about the average price you paid for purchasing 3 shares here? 230 divided by 3. Come on, tell me. 76.67. Am I right? So this will be the X right price, 76.67. Currently the share price is 90 traded in the market. If you are eligible for the right shares, you need to have already 2 shares. For holding the 2 shares, you assume that to be purchased in the market at rupees 90 each, so 2 into 90, 180. Now you are eligible for 1 right shares at, that can be purchased at rupees 50, means you have to pay another 50. So 180 plus 50, 230 you might have paid for 3 shares. So roughly 76.67 will be the share value per share. Okay. You divide that market price by 76.67. What is the ultimate value? 1.1739. This is the right factor. So I had to multiply the number of shares with this right factor, 1.1739. 5 lakhs into this one, come on. That too, this issue happens in which date? 31/7/21. You have to use the weighted average also. You have to use the weighted average number of shares concept here. So the current year starts on, don't directly multiply with this, 5 lakhs. When the right issue happens, 31/7/21. So 1/4/21, then 31/7/21, 31st March 21. You have 5 lakh shares. Here 5 lakhs into this one. What is the value you will be getting? You calculate here 5 lakhs into this one. 5 lakhs, 5 lakhs 86,000 here. 5 lakhs 86,950. Am I right? You multiply these two and get the value. Thereafter, you issue full shares. You issue full share. Then you will have how many shares here? One second. I'll finish off calculating this first of all. In denominator, this value being 5 lakhs 86,950, and divide this by this one. What is the ultimate value you will be getting? 1.32. So 5 lakhs in the right factors multiplied to find out the diluted EPS. Now, what about the EPS calculation for the year 21-22? Basic EPS. You can calculate the basic EPS. Here earnings for this period being 13.5 lakhs into 1 minus T being 0.3 divided by, what about the value here? Up to this, you have bonus shares. Here, you issued how many shares extra? 5 lakhs means 2.5 lakhs shares issued already on this date. So here you will be having 7,50,000 shares. How many months you have for, how many months you have 5,86,950 shares? 1/4 to 31st July, for 4 months you have this much. Thereafter, for the remaining months of the period, you have 7,50,000 shares. Now multiply these two, cumulative, come on. Total of this one, total value being 83 lakhs 47,800. Divide this by 12. What is the ultimate value you will be getting? 6,95,650. So you have to divide this by 6,95,650. Then you will get the EPS in this case being 1.36 roughly. So in case of right shares, you have to find out the right factor, multiply the right factor with the shares 5 lakhs, and you will get the answer easily. Make a note of it. In the next illustration, we have the options warrant. In this case, how can we calculate? Net profit for the year being 6 lakhs, weighted average number of equity shares outstanding during the year being 2,50,000. Average fair value of 1 equity share during the year being 20. Exercise price for shares under option during the year being 15. And weighted average number of shares under option during the year being 50,000 rupees. 20 rupee share can be purchased at 15 because of the option you have. 5 rupees is the free shares. Like to the extent of free share, it will be considered as bonus share. So EPS is equal to earnings available to equity shareholders divided by weighted average number of equity shares. 6 lakhs divided by 2.5 lakhs. What is the final value? 2.4. And in case of diluted EPS, potential earnings available to the equity shareholders divided by potential weighted average number of equity shares. There will not be any change in earnings available to equity shareholders, but the number of shares being already we have 2 lakhs 50. There's a free share out of 20, 15, otherwise 5 rupees per every 20 is free. How many options are there? 50,000 options are there. Then what is the final value? I think it is 2 lakhs 62,500. Then diluted EPS in this case being 2.286. Diluted EPS. So few more theory are going to be covered now. Contingently issuable shares. This is nothing but outstanding shares. Okay, but included in the calculation of diluted EPS. Probably the company may give some guarantee to issue the shares to some buyers. That is called contingently issuable shares. Okay, as per the contingent share agreement. Automatically, we have to issue at much discounted price of free shares, like it is actually lost to the company. It will have the effect of dilution in EPS, so you have to incorporate this. Contracts that may be settled in ordinary shares or cash. Sometimes you have the contract, like purchase of any assets or settlement of any debt or any other options. For those, the settlement is in the form of shares, or sometimes it may be cash. In case of you are paying that in the form of ordinary shares, the potential ordinary shares will be increasing and it will have the dilution in EPS. Another one is purchased options. So contracts such as purchased put options or purchased call options. Now no need to worry about the call and put options here. These two are considered as option and futures. Derivatives market, already I explained those things in the taxation class itself, right? Some other chapters also not required to understand here. In case of put and call options, we supposed to pay or issue the shares at much discounted price, and it will also have anti-dilution effect, and you have to give the treatment separately for this. Similarly, we have been given the written put options also. Okay. Now, I think this put option is not required for your level. You can skip this. Let's try one more illustration. Final illustration, this one. C Limited had 10 lakhs ordinary shares outstanding on 1/4/2020. On 1/1/21, it issued 2 ordinary shares as bonus for each shares outstanding. Earlier 10 lakhs, 2 bonus shares means it becomes 30 lakhs. The profit for the current year being 9 lakhs and the next year being 30 lakhs. So 2019-20 basic EPS being 9 lakhs divided by how many shares you have? 10 lakhs. 10 lakhs 0.9. What about the diluted EPS in that year? 9 lakhs divided by including bonus share, you have 30 lakhs in the denominator, 0.3. For the year 2021, you have to find out the basic EPS. In this year, your profit being 30 lakhs, by the time your share is also 30 lakhs, so basic EPS being 1 rupee. So with that, EPS concept is over. Let's see the theoretical aspect here. The main objectives of this Ind AS 33 being is to prescribe principles for determination and presentation of EPS so as to improve the performance comparisons. Okay, that's what about the ultimate aim of EPS. This is applicable for where the company issued ordinary shares. If the entity has no ordinary shares, then EPS will not come here. And the entity that discloses EPS should calculate EPS as per Ind AS number 33 only. Okay. An entity when presents both CFS and SFS, consolidated financial statement as well as separate financial statement, should also mention this EPS as per the Ind AS number 33. So anti-dilution already explained, contingent share agreement, contingently issued, so all these things already discussed here and there. And weightage will be given. In the weightage given part, you have to understand the cash, conversion of debt or any other convertible thing. And in case of partly paid up shares and purchase cash as well as merger cash, right shares and bonus shares. These things only you have to understand. The rest of the things you don't need to worry about that. So for the calculation of right factor also I have given the formula here. Anyhow you can understand without the formula also easily. The logic is okay. Okay. That's all. The rest of the things are very simple, the theory only. Okay. That's all about Ind AS number 33, especially for the calculation of EPS. Ind AS number 37, provisions, contingent liabilities and contingent assets. These are the three aspects that are going to be covered. Main objectives of this Ind AS number 37 being ensures that appropriate recognition criteria and measurement basis if there is any contingent liability, assets and provisions. Okay. And you have to disclose it properly so that users can understand the nature and timing of amount all these things payable supposed to be happening in the future. Okay. These are the three aspects: recognition, measurement and disclosure. This standard shall be applied by all entities for provision, contingent liabilities and contingent assets. But in case of executor's contract, this will not be applicable. Or where the contract is onerous, then it will be applicable. Onerous contract will be applicable, otherwise not applicable. Executors, those resulting from executor contract, not applicable. Okay, where we have some other accounting standards for those. Okay. And what is called provision? A liability, but uncertain timing or amount. When to pay and what is the real amount payable, we are not sure, then it is called provision. Liability, over all the things are confirmed, we are supposed to pay. This is the present obligation of the entity. It's our present obligation from the past event. 3 months ago, we purchased the material in credit. Because of that, we now supposed to pay the liability. So, purchase in credit is the past event. Payment for that is the present obligation, due being the present obligation. The settlement, how can you settle? That results in outflow of our cash or any assets of ours. 3 things: past event, present obligation. This will be settled by releasing some of the resources of the company. Then it is called liability. Now, provision is also liability. 2 things are not certain. One is timing, another one is amount. Liability is confirmed, what to pay, when to pay. Obligating event is nothing but the event which compels me to pay. Okay. An event that creates a legal or constructive obligation. Constructive obligation. Okay. And we don't have any other options to settle. We have to pay from our resources only. Okay. the event which is otherwise we cannot escape because it's a legal obligation. Legal obligation. What is called legal obligation? A contract. Probably while selling the goods, I gave the guarantee for 1 year. Anything happens, you can come and ask for the replacement. Such a way, if I give the warranty or guarantee, also be considered as legal obligation, or it may be contract. It's my contract, and sometimes it's a legislation. Some product may be dangerous for the consumption. I have not intimated properly. The consumer now levies he sues on me in the court for the compensation. This is called legislation or other operations of law. Because of these reasons, I supposed to pay for a compensation. Then it is called legal obligation. So because of the legal obligation, I have no other option. I have to definitely meet those obligations out of my resources. Then it is called obligating event. Is that okay? Very often I use the term constitutive obligation. Okay, is nothing but this is an entity's actions. Okay, derives from an entity action. Okay, so by an established pattern of past practices, a company constantly does replacement for the past 10 years. As a customer having the awareness that anything goes bad, this company will definitely replace. Because of that intention, if you purchase, then it's the company's requirement to fulfill. When there is a mistake, they have to refill. Okay, replace that. Okay, by an established pattern of past practice or published policies or sufficiently specific current statement, the entity has indicated the other party that it will accept certain responsibilities. It's okay. It's a practice. Either it may be published or simply practice. They're supposed to give. Whenever you purchase any commodity, the shop gives you 3 months warranty. It happens for over a decade period. Then it's naturally a constitutive obligation for the company. Is that okay? As a result, the entity has created a valid expectation on the part of those other parties that it will discharge those responsibilities. If there is any fault, you will come to me, I will just discharge this one. There is no any legal obligations, but it is a constitutive obligation. Is that okay? Maybe legal or constitutive. Constitutive is nothing but the company's policy itself. Clear? And what is called contingent liability? Contingent liability. So, here liability, here contingent liability. In case of contingent liability, a possible obligation from past events. Okay, but it is possible obligation. Is confirmed, whose existence will be confirmed by occurrence or non-occurrence. By occurrence or non-occurrence. Is that okay? I sell the goods giving a guarantee for 1 year. What happens? Within 1 year, the goods I supplied may be lost or maybe malfunctions. If it malfunctions, it will come. If it not malfunction, it will not come. So may happen, may not happen. Then it is called contingent liability. If I sell the goods to you, so A sells the goods to B, worth rupees 10,000 rupees. Okay, what happens in 1 year's time? This will perform better or it will malfunction. So it will not malfunction, malfunctions. If it malfunctions, this fellow comes to you and it's your duty to replace. By the time replacing or repairing amounts to rupees 2,000 rupees loss. So this 2,000 will be considered as contingent liability. May possible to pay or may not be. Okay, so this payment is based on the malfunctioning of this or malfunctioning. Is that okay? This is called possible obligation. Not only that, we may have the present obligation. This is called possible obligation. It may happen or may not happen. In case of present obligation, already happened. That arises from past events. Okay, but not recognized because it is not probable that an outflow of resources embodying economic benefits will be required to settle, or the amount of obligation cannot be measured. Cannot be measured or probable outflow. These two. Okay, for example, A supplied the goods to B worth rupees 10,000, but A has given no guarantee. No guarantee. But this product malfunction. Immediately B approached A, but as per the contract, A has not committed to replace this, but he immediately goes to the court. So as B approaches the court may give the judgment in favor of B or A. If the judgment is in the favor of B, then automatically A has to pay 10,000 rupees. If the judgment in favor of A, no payment will be done. But anyhow, it is based on the judgment given by the court only, it's a present obligation. But the problem is, if I am winning, there will not be outflow. The outflow is probable. There's a chance of winning, there's a chance of losing. There's a chance of winning being 60%, losing being 40%. Is that okay? So if I am losing, there's a probability of paying 10,000 rupees. If I am winning, I don't pay anything. Next one is, if I lose, how much I will pay, that is also not sure. In these two cases, this will be called as present obligation, not recognized as your liability, because these two reasons. One is the situation that judgment may be in favor of me or not in favor of me. Another one is because of unfavorable situation, how much I have to pay also be not clearly measurable. In these two reasons, this will be called as contingent liability. Two things are there in contingent liabilities. One is possible obligation, another one is present obligation. In case of possible obligation, it's my guarantee. As per the guarantee, the goods may go for malfunctioning or non-malfunctioning. Yeah, anything may happen. In case of worst things happens, I have to pay. Then it's called possible obligation. In case of present obligation, everything is happened, I'm supposed to pay, but the payment is not measurable properly, or the payment may or may not happen. In that case, this will be called present obligation. And what happens in case of contingent assets that's inverse of this one. Okay, is possible asset that arises from past event whose existence will be confirmed. All the things are similar. Clear? So the inverse of contingent liability is the contingent asset. Usually we never bother about the contingent assets to be recognized. In case of contingent assets, we have to record only on confirmed recognition. And you have to understand on onerous contract. What is called onerous contract? A contract in which the unavoidable costs of meeting the obligations under the contract exceed the economic benefit expected to be received under it. Okay, this is called onerous contract. For example, A and B. A has given the commitment to dig a bore well for 300 meter. Is that okay? At a cost of rupees 1,000 per meter. So 3 lakhs quotation was already given. Okay, so what happens, as per the contract, A cannot escape. And suddenly what happens, exactly 200 meters after, there's a rocky surface. Because of that, the value we spend for boring or drilling further cost us another 2 lakhs additional. Already I spent 2 lakhs, another 2 lakhs. Anyhow, because of my commitment, I have to do this at my cost. Okay, 4 lakhs is overall cost, but revenue is 1 lakh only. So 1 lakh additionally I have to spend. No, that is called onerous contract. Is a contract in which the unavoidable cost is. What is the unavoidable cost is? I have to dig further for 300 meters. Overall 300 meters, already 200 meters drilled, another 100 meters supposed to be drilled. Unavoidable cost is, what is that? The additional 2 lakhs is to be incurred of meeting the obligation under the contract exceed the economic. What is the economic benefit? This 3 lakhs is the economic benefit, but my additional cost is 1 lakh. So this 1 lakh I supposed to pay is due to the onerous contract. Is that clear? And a restructuring is a program that is planned and controlled by management and materially changes either the scope of the business undertaken by an entity or manner in which the business is conducted. Okay, this is what about the restructuring is a program. Okay, restructuring. Whatever the things they do, they want to suddenly make a total change, is called restructuring. Now, provision and other liabilities. Already we discussed what is called provisions and other liabilities also, right? And provisions and contingent liabilities also defined here. How do we recognize? Here? In case of provision, how do we recognize the provision? Okay, provision, contingent liabilities, contingent assets. Usually, contingent assets shall not recognize, should not be recognized, because as per the realization concept, in case of any revenue, should be recognized only on realization, so it will not be recognized. But it can be disclosed by way of notes to accounts if there is an inflow of economic benefit is probable. Okay, usually it should not be disclosed in your books. But in case of provision, shall be recognized in your balance sheet. Contingent liabilities means in your balance sheet, non-current liabilities and current liabilities. Under current liabilities, provision should be shown. When? If the provision being present obligation may be legal or constructive as a result of past. Number one, it should be present obligation, and there should be probable outflow of resources embodying economic benefit. Okay, and you can estimate reliably. So estimate, it's not perfect one, but you can estimate. If these conditions, three conditions are satisfied, then it will be a provision to be recognized in your books. Okay, if these conditions are not recognized, then it will not be recognized as provisions in your balance sheet. Is that clear? In case of contingent liability, it will be shown as a separate item below the balance sheet. Okay, so an entity shall not recognize the contingent liability. Okay, but contingent liability is disclosed. Okay, when? Unless possibly of an outflow of resources embodying economic benefit is removed. Okay, it can disclose. Okay, so the possibility of outflow because of this contingent liability is being removed, you no need to disclose. Okay. Now, for example, in case of contingent liability, okay, may be remote, may be probable. So, probable or possible. This you can note this as a note, but it is not required to be given in note form also, not note form also. Is that clear? Probable, you can show this as a small note below the balance sheet. But if the contingent liability being jointly and severally liable, okay, probably 10 lakhs is the contingent liability, payable the responsibility of payment being in the hands of A, B, C, three entity, and now I'm going to account for A means what is his portion, maybe 30%. Only 3 lakhs would be shown as contingent liability as a note form. Is that okay? Clear? So that the last one is not required to be shown at all. How can we measure? So measurement we will see along with the illustration so that we will be able to understand this easily. Question number 1. An entity sells goods with which customers covered of the cost of repairs of manufacturing defects that become apparent within first 6 months after the purchase. So A to B, 6 months warranty is there. If the minor defects were detected, okay, minor defects were detected, in all the products sold, repair cost being 1 lakh. So, in 6 months, there may be chances of minor defect. In that case, 1 lakh will be repair cost. If major defects were detected, okay, in all the products sold, repair cost would be 4 lakhs. The entity's past experience and future expectations indicate that for the coming year, 75% of the goods sold will have no defect. So no defect. So you don't have any spending. What is the probability of finding no defect? 75%. 20% goods sold will have minor defect. 5% will have major defect. Okay. Now calculate the amount to be provided. The amount to be provided is nothing but multiply these two, and this is the amount to be provided as your provisions. Contingent liabilities. Provisions. Okay. Provision for repairs. Come on. 1 lakh into 20%, 20,000. 4 lakhs into 5%, 20,000. And 0, the total value being 40,000. 40,000 will be this one. Clear? Now next one being this one. An entity has an obligation to restore an asset for damage it has in the past. It has 20 lakhs cash to pay on 31/3/2020 relating to this liability. The entity considers that 15% is an appropriate discount rate. The time value of money is considered for material. Calculate the amount to be provided. So, maybe assumed to be 2 years later. It has 20 lakhs cash to pay on this date. Okay. The information is missing. The entity has an obligation to restore an asset for damage it has in the past. Okay, we assume the 2 years period is there to pay this amount. Then what happens? 20 lakhs divided by 1.15 to the power 2. So you have to make a provisions for how much? 15.12 lakhs. You have to use the present value factor here. Present value factor. Is that clear? 2 years is missing there in the question. To pay by 2 years, that's how you can change. Not on 31/3/2020. Cash to pay by 2 years. Next one being changes in provisions. Also you'll be able to understand with the illustration. X Limited has become subject to an obligating event on 1/4/2020 for which the company is committed to expenditure of rupees 5 lakhs at the end of 10 years. An appropriate discount rate is 10%. Show how the same is to be treated by X Limited. Show the treatment up to this year. So on 1/4/2020, this company is supposed to pay 5 lakhs by the end of 10th year, means you have to divide this by 1.1 to the power 10. Is that okay? Present value factor. 1,92,772. This is the amount you are supposed to provide on 1/4/2020. What happens on 1/4/2021? The same 5 lakhs supposed to be payable, but you still have how many years? Only 9 years. So you have to take the present value for the 9 years. And this value being 2 lakhs 12,049. And 1/4/22, you have only 8 years. So 1.1 to the power 8 years. This value being 2,33,254. Otherwise, every year you have to add the interest. Interest 10% on this being 19,277 is added with this. In this case, 21,205 is added here. Now, how can you pass journal entry here? Okay, expenses account debit to provision. The expenses debited to the P&L account but not paid, it will be available as provision in your balance sheet, you know, so you have to show this one in the very first year. Next year, you have to further increase this by 19,277. So this will be named as expenses due to interest to provision account. This value being 19,277. Then again expenses, interest, debit, this value being 21,205 to provision. That's how the provision will be increasing year on year. In your balance sheet, shareholders funds, non-current liabilities, current liabilities, under that we have the provisions. In that provision, this number will be appearing. Last year 2,33,254 will be appearing. Is that clear? So this is how we can account this. This is how we can account this one also. Clear? So use of provision and accounting of provision also we have discussed. The same is given here. It's only a theory component. How do you disclose finally related to the provision as well as contingent liabilities, contingent asset also you have to disclose below the financial statement. This is also required as per Ind AS number 37. Is that clear? So with that, all the concepts related to the Ind AS are over for you. Okay.